The global financial system is not breaking, but it is quietly reconfiguring. Power is shifting not through declarations or crises, but through subtle changes in behavior that are now converging. Capital is moving differently. Risk is being priced differently. Institutions are responding to incentives that did not exist a decade ago. What once felt structurally fixed is becoming conditional. This matters now because these adjustments are occurring simultaneously across currencies, trade networks, reserve management, and policy coordination at a time when debt levels are high and geopolitical trust is thin. The system still functions, but it does so with less automatic stability and less tolerance for error. This is not a sudden transition, but the cumulative effect is profound. The foundations of global finance are being stress tested in real time, and the outcome will shape how shocks are absorbed, who bears the cost, and where influence ultimately resides. Dollar centrality is becoming more conditional rather than absolute, and this shift is now visible across the deepest layers of the global financial system. The US dollar continues to function as the primary unit of account, medium of exchange, and store of value for international finance, yet the mechanisms that once made its dominance reflexive are slowly changing. For decades, dollar strength during periods of stress was treated as an almost mechanical outcome. Capital fled risk, flowed into US assets, compressed yields, and reinforced the dollar's central role without requiring explicit reassurance from policymakers. That pattern is no longer guaranteed. It is not disappearing, but it is becoming contingent. Markets are increasingly evaluating the dollar not as an unquestioned safe harbor, but as a systemically important asset whose attractiveness depends on the credibility, coherence, and discipline of US policy choices over time. At the core of this transition is a recalibration of trust. Dollar dominance has always rested on more than economic size or military power. It has depended on confidence that US institutions would remain predictable, that markets would stay open and liquid, and that policy frameworks would be broadly consistent even through political cycles. Those foundations remain intact, but they are no longer taken for granted in the same way. Investors are scrutinizing fiscal trajectories more closely. Central banks are weighing the long-term implications of persistent deficits and rising issuance. Corporations operating across borders are assessing operational exposure to dollar funding and settlement. None of these actors are exiting the dollar system, but they are reducing their reliance on assumptions that once went unexamined. This change is most visible in the behavior of capital during periods of uncertainty. Historically, global stress triggered near-automatic dollar appreciation as investors unwound positions, covered funding needs, and sought the depth of US Treasury markets. Today, those flows still occur, but with less force and less uniformity. In some episodes, inflows are more selective, favoring shorter maturities or higher quality collateral rather than broadly supporting the dollar across the curve. In others, capital splits between dollar assets and alternative havens, reflecting a more nuanced assessment of risk. This does not represent a loss of confidence in the United States. It reflects a world in which options have expanded and where reliance on a single anchor carries its own form of risk. The growing functionality of alternatives is central to this dynamic. Over the past decade, non-dollar payment systems, local currency trade arrangements, and regional liquidity mechanisms have matured quietly. Their purpose has not been to replace the dollar, but to reduce friction and vulnerability in specific corridors. As firms and financial institutions gain experience operating outside dollar channels, the psychological and operational barriers to diversification decline. Habits that once reinforced dollar dominance begin to loosen. The dollar remains the most efficient choice in many contexts, but it is no longer the only workable one. That distinction matters. Dominance sustained by exclusivity behaves differently from dominance sustained by preference. As a result, the dollar's strength has become more sensitive to signals that markets previously discounted. Fiscal signaling now carries greater weight. Rising debt levels are not inherently destabilizing for a reserve currency issuer, but the absence of a credible long-term framework introduces uncertainty that markets must price. Political stability and institutional continuity also matter more. Episodes of brinkmanship, delayed resolutions, or conflicting policy messages inject noise into expectations that were once smoother. Monetary consistency remains critical, but it cannot compensate indefinitely for fiscal ambiguity or political fragmentation. He dollar's value increasingly reflects the interaction of these factors rather than an assumption of automatic supremacy. This shift alters the dynamics of currency and funding markets. The stabilizing asymmetry that once favored the dollar in every stress episode is less reliable. Two-way risk has increased. The dollar can still strengthen sharply when global conditions deteriorate, but it can also weaken if stress is perceived as originating from within the US policy environment or if investors judge that diversification provides adequate protection. This introduces greater volatility into exchange rates and hedging costs. For global borrowers, funding conditions become more variable. For investors, correlations that once held reliably can break down more easily. complicating portfolio construction and risk management. Importantly, this evolution does not imply systemic fragility or imminent disruption. The dollar remains embedded in global finance at a scale no other currency can match. U.S. markets retain unmatched depth, transparency, and legal protections. What is changing is the margin of safety provided by unquestioned dominance. When confidence is deep and automatic, the system absorbs shocks with minimal friction. When confidence becomes conditional, shocks are still absorbed, but the process is less smooth and more sensitive to missteps. Small policy errors or communication failures can have outsized effects because the cushion of assumption has thinned. The implications extend beyond currency markets into broader financial stability. U.S. Treasuries sit at the center of global collateral chains. Their role depends not only on creditworthiness but on liquidity and trust in governance. As demand becomes more price-sensitive and less reflexive, yields respond more quickly to shifts in sentiment. This feeds into borrowing costs across the economy, influencing investment decisions and fiscal space. The feedback loop that once reinforced dollar strength and low funding costs becomes more conditional, requiring active maintenance through credible policy alignment. For policymakers, this environment demands a different posture. Directional control through intervention is less effective than consistency over time. Markets are not asking for perfection but for coherence. Clear fiscal paths, predictable monetary frameworks, and disciplined political processes reinforce confidence incrementally. When those elements align, the dollar's central role is reaffirmed even in a more competitive landscape. When they diverge, the cost is not immediate collapse, but a gradual repricing of risk that accumulates over cycles. From a geopolitical perspective, conditional centrality reshapes influence. Financial leverage derived from dollar dominance remains substantial, but it operates through confidence rather than inevitability. Sanctions, regulatory reach, and access to U.S. markets still carry weight, yet their effectiveness depends on the absence of credible substitutes. As alternatives improve, influence must be exercised more carefully to avoid accelerating diversification. This places greater importance on domestic policy discipline as a component of external power. The boundary between internal governance and global influence has narrowed. What makes this moment particularly consequential is timing. These shifts are unfolding amid high global debt, tighter financial conditions, and elevated geopolitical risk. The system is adjusting its assumptions at the same time it is being tested by external pressures. Conditionality and dollar centrality does not weaken the system in calm periods, it increases sensitivity during stress. Markets react faster, reprice more quickly, and forgive less readily. Stability becomes something that must be demonstrated continuously rather than presumed. Ultimately, the transition from absolute to conditional dominance represents a maturation of the global financial system rather than a rupture. It reflects a world with more options, more information, and more interconnected risks. The dollar remains central, but its role is now evaluated rather than assumed. That distinction reshapes behavior at every level, from reserve management to corporate treasury decisions to geopolitical strategy. The outcome will not be determined by a single event, but by the cumulative credibility of U.S. policy choices over time. In a system where centrality is conditional, trust is the most valuable asset, and it must be earned repeatedly, especially when it is needed most. Capital flows are fragmenting along economic and geopolitical lines, and this process is now sufficiently advanced to alter the functioning of the global financial system in measurable ways. For much of the post-Cold War period, cross-border capital allocation was guided primarily by yield differentials, liquidity depth, and perceived macroeconomic stability. Political alignment existed in the background, but it rarely acted as a first order constraint on financial decision-making. That hierarchy has shifted. Today, capital is still sensitive to returns and liquidity, but it is increasingly filtered through considerations of geopolitical exposure, sanctions risk, regulatory predictability, and strategic alignment. This evolution is not abrupt, nor is it driven by a single actor or event. It is the cumulative result of policy decisions, institutional adaptations, and market learning over time. The consequence is a system that remains globally interconnected, yet structurally more segmented and less uniformly responsive than before. At the center of this shift is a reassessment of what constitutes risk. Traditional financial models treated political risk largely as a tail event, relevant primarily in emerging markets or fragile states. That assumption has weakened. The use of financial instruments as tools of statecraft, the expansion of extraterritorial regulation, and the growing linkage between trade policy and security considerations have pushed political exposure into the core of investment analysis. Capital allocators now assess not only whether an asset is liquid and profitable, but whether its jurisdictional context introduces vulnerabilities that could crystallize under stress. This recalibration has profound implications because it changes behavior even in the absence of crisis. Decisions are adjusted ex ante, reducing concentration and building optionality rather than reacting after disruption occurs. Trade settlement diversification illustrates this process clearly. As more trade is settled in local or regional currencies, firms reduce their dependence on a single financial channel for working capital and payments. This does not eliminate exposure to global markets, but it redistributes it. Banks develop parallel capabilities. Corporations manage multicurrency balance sheets with greater sophistication. Over time, these operational adjustments become embedded practice rather than contingency planning. When multiplied across thousands of firms and institutions, the aggregate effect is a gradual rerouting of capital flows. Liquidity that once moved predictably through a narrow set of hubs now circulates through a broader network of channels, each shaped by its own regulatory and political context. Regional financial arrangements reinforce this trend. Development banks, swap lines, and localized funding mechanisms provide backstops that reduce the necessity of drawing on global dollar liquidity for every shock. These tools are not substitutes for the global system, but supplements that alter incentives at the margin. When institutions know that regional liquidity support exists, even if limited, their behavior changes. They are more willing to hold non-core assets, more selective in their use of global funding, and more attentive to the political contours of their exposure. The system does not fragment into isolated blocks, but it loses some of the homogeneity that once simplified coordination. Alternative payment systems play a similar role. Their significance lies less in transaction volume than in optionality. The presence of viable alternatives reduces the cost of diversification and lowers the perceived risk of operating outside a single dominant framework. Once optionality exists, it influences behavior even if rarely exercised. Capital becomes more discriminating, flowing not only toward the highest return, but toward the most resilient configuration of returns under multiple scenarios. This logic is especially powerful for large balance sheets, where even small percentage shifts translate into substantial absolute reallocations. The fragmentation that results is subtle but persistent. Capital is not withdrawing from global markets, it is being reweighted. Some jurisdictions see reduced inflows not because of deteriorating fundamentals, but because their political or regulatory trajectory introduces uncertainty that investors can now more easily avoid. Others attract capital not solely due to superior returns, but because they are perceived as neutral, predictable, or strategically aligned. Over time, this reshaping of flows alters liquidity conditions. Markets that once benefited from consistent foreign participation become more reliant on domestic demand. Those with strong external alignment may experience greater stability, but also greater sensitivity to shifts in geopolitical relationships. Volatility at the margins increases as a result. When capital is evenly distributed and guided by shared assumptions, shocks are absorbed smoothly. When capital is more selective and segmented, adjustments occur unevenly. Prices move faster in response to new information because positions are less uniformly held. Correlations weaken. Assets that once moved together diverge based on jurisdictional context rather than economic similarity. This does not create constant instability, but it does make periods of stress more complex. Market signals become harder to interpret because they reflect overlapping economic and political judgments. Coordination during crises becomes more difficult in this environment. In a highly centralized system, responses can be swift because channels are standardized and trust is broadly shared. Fragmentation introduces legal, regulatory, and political frictions that slow collective action. Liquidity provision may still be ample in aggregate, but its distribution is less predictable. Institutions hesitate not because they doubt solvency, but because they must navigate a more intricate web of constraints. Time, which is critical during stress, becomes more costly. This places greater responsibility on domestic policy discipline. When external buffers were deep and predictable, policy errors could be absorbed with limited immediate consequence. In a more fragmented system, those buffers are thinner and less reliable. Fiscal signaling matters more because foreign capital is quicker to reassess exposure. Monetary credibility matters more because spillovers are less automatic. Political stability matters more because it influences not only domestic confidence, but the willingness of external actors to maintain engagement during uncertainty. The margin for error narrows even as the system remains fundamentally robust. Importantly, fragmentation does not imply disengagement. Interdependence persists through trade, finance, and supply chains. What has changed is the texture of that interdependence. It is more conditional, more selective, and more sensitive to alignment. This reshapes strategic calculations for states and institutions alike. Influence derived from centrality must now be maintained through credibility rather than assumed through structure. For capital allocators, the challenge is to balance efficiency with resilience in a world where the two are no longer perfectly aligned. As this process continues, its effects compound. Each incremental adjustment reinforces the next by normalizing diversification and embedding new practices. The system adapts without dramatic rupture, yet its behavior under stress evolves. Stability is preserved, but it is less automatic and more dependent on coordination that must be actively managed. In such a system, confidence remains the ultimate lubricant, but it is distributed across multiple centers rather than concentrated in one. Fragmentation in this sense is not the breakdown of global finance, but its transformation into a more complex and demanding environment where discipline, clarity, and alignment carry greater weight than at any point in recent decades. Policy credibility has replaced intervention as the primary stabilizer in the global financial system, and this shift marks one of the most consequential structural changes in how markets process risk, authority, and reassurance. For much of the modern era, stability was enforced through visible, often decisive action. Central banks intervened directly in markets, governments deployed fiscal stimulus aggressively, and institutional power was demonstrated through scale and speed. These tools remain available, but their stabilizing effect has diminished relative to earlier cycles. Markets now place greater weight on coherence, consistency, and durability of policy frameworks than on the magnitude of any single intervention. This evolution reflects a system that has grown larger, more leveraged, more interconnected, and simultaneously more fragmented. In such an environment, force alone no longer guarantees confidence. Instead, belief in the underlying logic and sustainability of policy has become the decisive anchor. The reasons for this shift are structural rather than cyclical. Global debt levels are materially higher across sovereign, corporate, and household balance sheets than in previous decades. Financial markets are more deeply integrated into everyday economic functioning, and asset prices play a larger role in transmitting policy effects. At the same time, geopolitical fragmentation and regulatory divergence have reduced the uniformity of market expectations. In this context, aggressive intervention can no longer be interpreted automatically as stabilizing. It can just as easily be read as evidence of stress, improvisation, or lack of strategic clarity. As a result, markets increasingly judge policy not by what is done in the moment, but by whether actions fit within a credible, internally consistent framework that extends beyond the immediate horizon. Credibility operates differently from intervention. Intervention acts on prices directly, credibility acts on expectations. When credibility is high, markets adjust preemptively, often reducing the need for overt action. When credibility is weak, even large interventions can fail to reassure, forcing policymakers into repeated escalation. This distinction has become central as the global system transitions away from a highly centralized, hierarchical sense. Rupture toward one characterized by overlapping authorities and partial alternatives. In such a system, no single actor can impose stability unilaterally without market cooperation. Cooperation, in turn, depends on trust that policies are not only reactive, but intentional and bounded. Fiscal policy illustrates this dynamic with increasing clarity. Markets are no longer focused solely on headline deficit figures or debt-to-GDP ratios in isolation. Instead, they're scrutinizing the governance structures that shape fiscal outcomes over time. Clear medium-term frameworks, credible revenue assumptions, and political mechanisms capable of adjusting policy when conditions change now matter as much as near-term stimulus or consolidation. When governments rely on short-term fixes, temporary measures, or optimistic assumptions without demonstrating a path to sustainability, markets respond by demanding higher compensation for risk. This response is not ideological, it is procedural. Investors are signaling uncertainty about the rules of adjustment rather than the arithmetic alone. Monetary policy faces a parallel challenge. Forward guidance, balance sheet policy, and interest rate decisions are now interpreted through the lens of institutional consistency. Markets are sensitive to whether central banks appear constrained by political pressure, fiscal dominance, or shifting mandates. When communication is clear and actions align with stated objectives, markets can absorb tightening or easing without destabilization. When signals conflict, volatility rises sharply. The credibility of monetary policy is no longer anchored solely in independence as a formal principle, but in the demonstrated ability to act predictably across cycles, even under pressure. Political decision-making has become an equally important component of credibility. Markets are not evaluating political systems based on ideology, but on functionality. The ability to pass budgets, honor commitments, resolve disputes, and adapt policy without prolonged uncertainty directly affects risk perception. Repeated standoffs, delayed resolutions, or abrupt reversals undermine confidence not because they imply collapse, but because they introduce ambiguity into future policy behavior. In a highly leveraged system, ambiguity itself is costly. It raises the probability of adverse outcomes and therefore increases the price of capital. What distinguishes the current environment from earlier periods is that historical performance no longer provides sufficient reassurance. Past episodes of crisis management, while still relevant, do not guarantee future effectiveness. Markets recognize that structural conditions have changed. Higher debt burdens reduce flexibility, aging demographics constrain growth, Fragmented monetary alignments complicate coordination. Under these conditions, credibility must be earned continuously rather than inherited. Each policy decision is evaluated not only on its immediate impact, but on what it reveals about institutional discipline and strategic intent. The erosion of credibility is rarely dramatic. It occurs incrementally through small inconsistencies that accumulate over time, a temporary fiscal measure extended repeatedly without justification, a monetary signal walked back under political pressure, a regulatory promise delayed or diluted. Individually, these events appear manageable. Collectively, they reshape expectations. Risk premia rise not because investors expect default or crisis, but because they perceive a weaker commitment to rule-based adjustment. Funding costs increase gradually, liquidity becomes more selective. The system continues to function but with reduced tolerance for error. This has direct implications for how shocks are absorbed. In a credibility-driven environment, the effectiveness of policy response during crises depends heavily on prior behavior. When markets believe that adjustments are intentional, bounded, and reversible, they are more willing to extend confidence during stress. Liquidity flows more freely. Volatility is contained. When credibility is in doubt, the same policy tools produce weaker results. Interventions must be larger and more frequent to achieve the same effect, and even then may fail to anchor expectations fully. The difference lies not in capacity but in trust. The concept of reversibility is particularly important. Markets are increasingly attentive to whether policy measures taken in response to stress can be unwound without destabilization. Temporary interventions that become permanent undermine credibility by signaling a lack of exit strategy. Conversely, clearly defined contingencies and sunset mechanisms enhance trust by demonstrating control. In a system adjusting to new equilibria, the belief that policy is adaptive rather than trapped is a critical stabilizer. The shift from intervention to credibility also redistributes responsibility across institutions. Stability can longer be delivered solely by central banks or finance ministries acting in isolation. It requires alignment across fiscal authorities, monetary policymakers, regulators, and political leadership. Inconsistency between these actors is quickly reflected in market pricing. This places a premium on institutional coordination and disciplined communication. Fragmented messages are interpreted as fragmented authority, even when underlying capacity remains strong. Importantly, this evolution does not signal the disappearance of state power in finance. Governments and central banks retain significant tools and resources. What has changed is the channel through which that power is exercised most effectively. Influence now flows through expectations management rather than price suppression. Authority is demonstrated through predictability rather than surprise. This makes stability more resilient in the long run but more demanding in the short term. It requires patience, transparency, and the willingness to accept near-term discomfort in service of long-term coherence. As the global system continues to adapt, the premium placed on credibility is likely to increase further. Capital flows are more selective. Currency dynamics are more two-sided. External buffers are thinner and less automatic. In this environment, policy errors are not catastrophic by default, but they are less easily absorbed. Each misstep is priced more quickly and forgiven less readily. Stability, therefore, is no longer something that can be imposed at will. It is something that must be cultivated continuously through consistent action and disciplined governance. The overarching implication is that the margin for improvisation has narrowed. Markets still respond to decisive action, but only when that action fits within a believable strategy. Absent that context, intervention risks amplifying uncertainty rather than reducing it. Policy credibility has become the system's primary stabilizer because it operates upstream of volatility, shaping behavior before stress becomes acute. In a world where financial structures are more complex and authority is more diffuse, this reliance on credibility is not a weakness. It is an adaptation. But it is an adaptation that raises the cost of inconsistency and elevates the importance of long-term discipline at precisely the moment when pressures to deviate are intensifying. The emerging global financial order is exhibiting a paradox that is becoming increasingly evident to policymakers and institutional investors. It enhances resilience during periods of relative calm, yet it simultaneously increases vulnerability when stress becomes systemic. This duality is not accidental. It is the direct consequence of a transition away from a highly centralized financial architecture toward one characterized by multiple anchors, diversified channels, and overlapping mechanisms of settlement, funding, and liquidity provision. In normal conditions, this structure distributes risk more evenly and reduces dependence on any single node. In abnormal conditions, however, it complicates coordination, slows collective response, and raises the economic cost of stabilization. The system does not fail outright, but it absorbs shocks less efficiently precisely when speed and unity matter most. In calm periods, diversification functions as intended. Capital flows are less concentrated, reducing the likelihood that localized disruptions cascade immediately across the entire system. Trade can continue even when one settlement channel experiences friction. Financial institutions can reroute transactions through alternative clearing mechanisms. Central banks can manage domestic objectives with greater insulation from external volatility. This modularity increases robustness against idiosyncratic shocks. A regional banking issue, a localized political crisis, or a sector-specific downturn can be contained more effectively than in a tightly centralized framework where stress transmits instantly through a single dominant conduit. The new order, in this sense, is more fault-tolerant. This resilience is reinforced by the gradual normalization of diversification as a prudent strategy rather than a political statement. Reserve managers, sovereign funds, and multinational corporations increasingly treat currency and funding diversification as standard risk management. This reduces herd behavior during benign conditions. Markets price assets with greater differentiation, reflecting local fundamentals and policy credibility rather than default correlations. Volatility is often lower because risk is dispersed across a wider set of instruments and jurisdictions. The system appears stable, adaptive, and balanced. However, this same dispersion of confidence becomes a liability when stress shifts from localized to global. Systemic crises demand rapid coordination, decisive liquidity provision, and shared expectations about backstops and burden sharing. In a centralized order, the existence of a dominant anchor simplifies this process. Market participants know where to look for reassurance. Liquidity flows toward a trusted core. Policy signals propagate quickly and uniformly. Even if interventions are imperfect, their intent is widely understood. In a distributed system, by contrast, confidence is fragmented across multiple centers, each with its own mandates, constraints, and constituencies. During stress, this fragmentation slows reaction times and dilutes the effectiveness of response. The challenge is not a lack of capacity, but a lack of synchronization. Multiple anchors mean multiple interpretations of events. Central banks may prioritize domestic stability over global coordination. Fiscal authorities may face divergent political constraints. Regulatory responses may differ across jurisdictions, introducing legal and operational uncertainty at precisely the wrong moment. Market participants, uncertain which anchor will ultimately absorb risk, become more cautious. Liquidity hoarding increases, funding spreads widen. The system continues to function, but at higher friction and cost. Confidence plays a central role in determining whether this friction remains manageable or becomes destabilizing. When confidence is widely shared and deeply entrenched, diversification does not impede coordination because expectations converge naturally. Market participants assume that despite institutional differences, authorities will act in complementary ways. Capital flows adjust smoothly. Temporary dislocations are bridged by private balance sheets. In such conditions, the distributed system performs well even under moderate stress. The problem arises when confidence is unevenly distributed or conditional. In that case, each shock is filtered through a lens of uncertainty about who will act, how far they will go, and whether actions will be aligned. This uncertainty alters behavior in subtle but important ways. Banks reduce cross-border exposures not because of immediate losses, but because of unclear regulatory responses. Corporations delay investment decisions due to currency and funding volatility. Investors demand higher risk premia for assets that depend on coordinated support. None of these actions signals panic. Together, they slow adjustment and deepen the economic impact of the shock. The system bends rather than breaks, but the bending itself imposes real costs. The increased vulnerability during stress is also linked to the reduced asymmetry that once characterized global finance. In the previous order, one currency, one sovereign bond market, and one set of institutions absorbed disproportionate inflows during crises. This asymmetry provided a powerful stabilizing mechanism. Capital flight from riskier assets translated into concentrated demand for the anchor, lowering funding costs and reinforcing confidence. In the new order, inflows are more dispersed. Safe haven demand is divided among several assets and jurisdictions, each credible but none dominant enough to absorb stress instantly and completely. The result is a more balanced system in theory, but a less decisive one in practice. This does not imply that the new order is inherently unstable. On the contrary, it is structurally more resilient to slow-burning risks such as gradual fiscal deterioration, demographic shifts, or long-term geopolitical realignment. Its vulnerability lies in the time dimension. Crises are defined by speed. When events escalate rapidly, the ability to coordinate quickly becomes paramount. A system optimized for flexibility and optionality sacrifices some of that speed. Decisions take longer, signals are noisier. Markets must interpret a wider array of policy responses, increasing the likelihood of mispricing and overreaction. The economic cost of this dynamic is cumulative rather than catastrophic. Slower adjustment means deeper recessions, longer recovery periods, and more persistent financial tightening than would occur in a more centralized framework. Governments may still succeed in stabilizing conditions, but at the price of higher debt, greater political strain, and reduced future policy space. These costs are not evenly distributed. Smaller economies, emerging markets, and highly leveraged sectors are disproportionately affected because they rely more heavily on swift restoration of global liquidity. The next major shock will therefore serve as a critical stress test for the evolving order. It will not determine whether the system survives, but how efficiently it adapts. The key variable will be confidence, not control. Control implies the ability to dictate outcomes through authority and force. Confidence implies the willingness of markets and institutions to align voluntarily with policy objectives. In a distributed system, control is inherently limited. Confidence is the only mechanism that can synchronize behavior across borders and balance sheets. If confidence holds, the system's diversity can become an asset even under stress. Multiple anchors can share the burden of stabilization, liquidity can flow through parallel channels, policy innovation can occur in more than one center simultaneously. If confidence falters, however, the same diversity becomes a source of hesitation and fragmentation. Markets wait for clarity that arrives too slowly. Authorities act defensively rather than cooperatively. The shock dissipates eventually, but only after imposing unnecessary economic damage. This tension between resilience in calm and vulnerability in stress defines the current transitional phase of global finance. It reflects a world in which no single actor can impose order unilaterally, but where collective action remains possible if trust is sufficiently strong. The quiet evolution of the system has reduced the likelihood of sudden collapse, but it has also raised the premium on preparedness, communication, and institutional coherence. Stability is no longer guaranteed by architecture alone. It must be actively maintained through shared understanding and credible commitment. The strategic implication is that managing the next crisis will require more than technical tools. It will require deliberate efforts to preserve confidence across a fragmented landscape. Transparency, consistency, and coordination will matter as much as balance sheet capacity. The new order can hold together under pressure, but only if participants believe that others will act responsibly and predictably. When that belief is widespread, the system's flexibility becomes a strength. When it is not, vulnerability increases even in the absence of overt disorder. Ultimately, the defining risk of the new global financial order is not instability in the traditional sense, but inefficiency under stress. Crises become more expensive not because they are more violent, but because they take longer to resolve. Confidence, once centralized, is now distributed. That distribution enhances resilience during normal times, but it raises the stakes during extraordinary ones. The true measure of the system's durability will be revealed not in periods of calm, but in how it responds when confidence is tested simultaneously across regions, markets, and institutions. In that moment, the quiet evolution of the order will cease to be theoretical and will become decisively real.